820 million ounces. That's how much silver the world has consumed beyond what it produced over the past 5 years. Imagine draining an Olympic swimming pool every year for 5 consecutive years. That's the silver deficit, and it's accelerating. But that's not the shocking part. The shocking part is what happened overnight. Silver blasted through $72 per ounce, a new all-time high, the 4th consecutive day of records, up 149% year to date, the strongest annual gain in modern history, stronger than 1979, stronger than 2010, and the buying isn't coming from speculators, it's coming from industrial users, solar companies, electronics manufacturers, EV producers. They're panic buying because they're realizing the physical metal isn't there. We've seen this movie before. Act 3 of a 4-act play. Rome debased their silver coins until workers demanded payment twice daily. The 1970s saw gold and silver explode after Nixon broke the dollar's gold promise. 1980 brought silver from $6 to $50 before the government changed the rules. Same pattern, different century, same ending. And if you understand the pattern, if you can see what comes next, you're watching the middle act of the greatest precious metals repricing in modern history. Not the beginning, the middle. And Act 4, that's where it gets interesting. Let's start at the beginning, 211 AD, Rome. Emperor Septimius Severus has a problem. The empire is expensive. Military campaigns across 3 continents, infrastructure projects, a massive bureaucracy, and the treasury is bleeding. Tax revenues can't cover it. The debt is mounting, and emperors don't default. They innovate. The Roman denarius, their silver coin, was supposed to be 90% pure silver under Augustus. By the time Severus took power, it had already been adjusted to about 50%. Financial engineering, they called it optimizing the monetary supply. Severus dropped it to 40%. His son Caracalla, 30%. By 270 AD, the silver coin was 5% silver, 95% copper with a silver wash. The Romans weren't idiots. They had economists. They understood cause and effect. They knew debasing the currency would cause inflation. They did it anyway. Because when debt becomes mathematically impossible to repay, you don't have good options. You have survival options. And what happened? By 301 AD, Emperor Diocletian issued price controls because inflation was catastrophic. Bread prices are changing daily. Workers are demanding payment twice per day because by afternoon, their morning wages couldn't buy food. The wealthy Romans who saw it coming didn't trust the debased coins. They hoarded pure silver, melted down old coins, stored bullion. Because when governments break their monetary promises, when paper becomes worthless, humanity always returns to the same answer. Physical assets, tangible stores of value. Things you can hold that can't be printed into existence. The Roman Empire spent the next 175 years slowly collapsing, not from military defeat, from monetary decay, from the moment they decided that debt was more important than currency integrity. That's Act 1, the pattern's origin. Debt leads to debasement. Debasement leads to crisis. And in crisis, real assets preserve wealth while paper promises fail. August 15, 1971. President Nixon appears on television. The gold window is closing. Temporarily, he says. The dollar will no longer be convertible to gold. It's a temporary measure to protect against speculators. It was never reopened. For 27 years, the Bretton Woods system worked. Every major currency is fixed to the dollar. The dollar was fixed to gold at $35 per ounce. Foreign central banks could exchange dollars for gold anytime. The promise that backed the global monetary system. But promises are expensive when you're running deficits. Vietnam War, Great Society programs, rising government spending. America was printing more dollars than it had gold to back them. France sent warships to New York Harbor to collect gold. Other countries quietly converted. The U.S. gold reserves were draining. 20,000 tons in 1944. Down to 8,000 by 1971. Nixon had no choice. He broke the promise. And immediately, inflation exploded. The dollar, no longer backed by gold, became pure fiat. A promise backed by nothing except trust. And trust, once broken, is hard to rebuild. What happened to gold and silver? Gold was $35 when Nixon closed the window. By 1980, $850. Silver was $1.40 in 1971. By January 1980, $49.95. Gold went up 24 times. Silver up 35 times. Not because of the Hunt brothers, not because of manipulation, because people lost faith in paper currency. Because when governments break their promises, when dollars aren't backed by anything tangible, smart money moves to assets that can't be printed. Gold, silver, things with intrinsic value. The 1970s weren't just inflation, they were a crisis of monetary confidence. People are watching their purchasing power evaporate, watching savings lose value daily, and they fled into precious metals, into real estate, into anything that wasn't paper promises. By 1980, gold and silver had both hit all-time highs. Not because they were expensive, because the dollar was cheap, because trust had collapsed, because the pattern was executing exactly as it had in Rome. Debt, debasement, crisis, flight to tangible assets. That's Act 2, the modern version. Different century, different names, same pattern, same result. Now let's talk about today, December 25th, 2025. Christmas Day. Silver closed overnight at $72.17, a new all-time high, the fourth consecutive day of records. Each session closed higher than the last, up 149% year to date. But here's what makes this different from every other rally. The buying isn't speculative, it's industrial, it's structural. Companies that need silver to manufacture products, rare Elizing supply doesn't exist at current consumption rates. The Silver Institute projects a 95 million ounce deficit in 2025, the fifth consecutive year. Total cumulative shortfall since 2021, 820 million ounces. That's not a forecast, that's actual. More silver is consumed than produced every year for half a decade, and consumption is accelerating. Solar panel manufacturing consumed 200 million ounces in 2024. Each panel requires about 20 grams of silver paste for electrical conductivity. No viable substitute exists at scale. The solar industry is projected to grow by 40% over the next 3 years. That's not 80 million more ounces of annual demand. That's structural, permanent, growing. Electric vehicles need silver, roughly twice as many as internal combustion vehicles. With EV adoption accelerating globally, that's 90 million ounces annually and rising. AI data centers require silver for circuitry and thermal management. 5G infrastructure, electronics, medical devices. Photography still uses silver. Every smartphone has silver in it. Industrial demand isn't cyclical anymore, it's structural, and it's growing faster than my supply can respond. Mine production grew 1% in 2025. 1%. And here's why it can't respond faster. 70% of silver comes as a byproduct of copper, zinc, and gold mining. If copper demand slows, if zinc prices drop, if gold operations cut back, silver supply falls regardless of silver's price. You can't just mine more silver, it doesn't work that way. New projects take 7 to 10 years from discovery to production, and there aren't many new projects. The Silver Institute forecasts new supply additions of only 44 million ounces over the next 5 to 10 years. 44 million. Against annual deficits approaching 100 million. The math doesn't work. Consumption exceeds production. Inventories drain, and prices rise until demand gets rationed, until users who need silver pay whatever price ensures supply, until marginal users get priced out, until the market reaches equilibrium. But we're nowhere near equilibrium, because COMEX inventories are disappearing. In early December, 47.6 million ounces were claimed for physical delivery. 4 trading days. That's 60% of registered inventory. Gone. Converted from paper contracts to physical metal. People aren't rolling contracts forward anymore. They're demanding delivery. Total COMEX inventories are down 73% since 2020. The warehouses that used to hold over 1 billion ounces now hold a fraction. In registered inventory, the metal available for immediate delivery is at multi-year lows. The physical market is draining. London lease rates spiked to 9%. To borrow silver, you pay 9% annually. Normal is 0.5%. 9% means someone desperately needs metal and can't source it. The futures market went into backwardation, spot price exceeding futures. That only happens when immediate delivery is worth more than promises of future delivery. China restricted silver exports starting January 1st. Only large state-certified companies producing at least 80 tons annually get licenses. That's 60 to 70% of global refining capacity about to be choked off. The main supply valve to Western markets is closing. India ordered 1,000 tons in October, $22.3 billion, half of the global annual mine production. One order. London lease rates instantly spiked from 0.25% to 200%. The entire market seized. Swiss refiners stopped accepting orders until 2026. And here's what triggered the overnight move. Reports emerged that major solar manufacturers in China and Germany are securing multi-year supply contracts at fixed prices. They're locking in metal now because they've run the numbers. They know the deficit is real. They know inventories are gone. They know if they don't secure the supply, their production lines stop. When industrial users panic buy, when they shift from just-in-time purchasing to hoarding, that's when markets break. Because industrial demand is price inelastic. Solar companies need 20 grams per panel. Electronics manufacturers need specific amounts per unit. They can't substitute. They can't reduce. They either pay the price or stop producing, and they're choosing to pay. At $72, at $80 if necessary, at $100 if that's what it takes. Stopping production costs more than higher silver prices. This is Act 3, the structural break. When the market realizes the deficit is real, when paper contracts can't deliver physical metal, when industrial users compete with investors for a limited supply, when price becomes the only rationing mechanism left. Let me show you the pattern clearly. The 4 acts explain where we are and what's coming. Act 1, debt accumulation. Every monetary system starts here. Borrow to grow, borrow to expand. Rome borrowed to conquer. America borrowed to fight wars and fund programs. Global debt now sits at $318 trillion, according to the Institute of International Finance. Debt to GDPI is 328%. We owe more than 3 times what the planet produces annually. Interest payments consume 15 to 20% of government revenues in developed nations. The debt trap, where you borrow not to invest, but to service previous debt, where the math stops working, where every option looks bad. Act 2, debasement. When debt becomes impossible to repay, governments have 3 choices. Default, political suicide. Austerity is also political suicide. Or debase the currency, slow suicide. But you stay in power longer. Rome clipped silver from coins. Nixon closed the gold window. Today, why we call it quantitative easing. Expanding the balance sheet, accommodative monetary policy. It's the same thing, creating money that wasn't there, diluting existing currency, debasement by another name. And when debasement accelerates, when paper currencies come under pressure, smart money moves into gold, into silver, into tangible assets that can't be printed. That's not speculation. That's 2,000 years of human behavior. Act 3, the flight. This is where we are now. Silver up 149% in 2025. Goldless is hitting record highs. Central banks bought 1,037 tons of gold in 2023. Highest in 50 years. China is cutting U.S. Treasury holdings to 16-year lows while accumulating precious metals. Not random, coordinated. Structural repositioning away from paper assets into physical stores of value. And it's not just governments. Industrial users are realizing supply is finite. Investors recognizing the deficit is structural. Everyone is moving simultaneously toward the same assets, creating the squeeze, the one-way market, where buy orders overwhelm sell orders, where each dip gets bought immediately, where resistance levels blow through like they aren't there. Act 4, the resolution. What happens when paper markets can't deliver physical, when industrial users can't source metal, when the gap between paper price and physical availability becomes unbridgeable? We're approaching Act 4, each day, each new high, each COMEX drain, each panic buying report from industrial users. History shows 2 possible endings. In 1980, the government intervened. COMEX changed the rules, banned new purchases, forced liquidation. The system saved itself by crushing the longs. Silver fell from $50 to $10 in a matter of months. But this time might be different because industrial demand is structural, not speculative. Because the deficit has persisted for 5 years, not 5 months. Because China restricted exports. Because solar, EVs, and data centers need silver regardless of price. And because the commercial banks allegedly flipped from short to long. JP Morgan reportedly holds 750 million ounces. The largest stockpile in history. They're not fighting the rally, they're positioned for it. So Act 4 could be an intervention and a crash like 1980, or it could be repricing. A permanent reset where silver doesn't trade at 15 or 30, but 70 or 100 or 150, where the market finds a new equilibrium based on structural reality, where supply finally matches demand, not through increased production, but through price rationing. Nobody knows which version of Act 4 we get, but we know Act 3 is executing. Right now, the pattern is playing out exactly as history says it should. So what does $72 mean? What does 4 consecutive days of all-time highs signal? It means then 1980 at peak wasn't a ceiling, it was a waypoint. $49.95 held for 45 years. Everyone said silver could never go higher, that the government would intervene again. The pattern always ends in a crash. But $72 says otherwise. It says maybe this time is different. Not because humans changed, not because governments got better, but because the structure changed, because industrial demand is permanent, because solar and EVs and data centers aren't speculative bubbles. They're the global economy. It means industrial users are panicking, securing multi-year contracts, hoarding metal, because they've run the math. 5 years of deficits, inventory's gone. China is restricting exports, and they need silver to operate, so they're bidding aggressively at any price that ensures supply. It means investors are starting to notice. Silver up 149% gets attention. Gold at 4,000 plus feels expensive. Silver at 72 feels accessible. You can buy meaningful amounts, build positions. And when retail FOMO kicks in, precious metals bull market moves go parabolic. And it means we're in uncharted territory. Silver above $50 is rare. It happened twice in history. 1980 and 2011. Both times it crashed shortly after. But both times the structure was different. The demand was speculative. The system fought it. This time, demand is structural. The system allegedly supports it. 4 consecutive days of new highs. Each closing is higher. That's not consolidation. That's acceleration. That's a market discovering it was mispriced for years and correcting violently. BNP Paribas says $100 silver is possible. Bank of America's technical team is bullish. UBS forecasting continued strength. These aren't fringe analysts. These are major institutions, recognizing what the fundamentals say, that $72 might not be expensive, might be cheap, if industrial demand keeps growing, if deficits persist, if the supply can't respond. In inflation-adjusted terms, the 1980 peak of $49.95 equals about $180 today. 72 is 40% of that, less than half the real height, which means silver could double from here and still not match its historical peak in real terms. The question isn't if silver goes higher. The fundamentals say it does. Structural deficits don't fix themselves. They persist until price ratios demand, until marginal uses get priced out, until equilibrium is reached. The question is how high and how fast, and whether there's a ceiling before $100, before $150, before whatever price finally brings supply and demand into balance. Let me be direct about what this is and what it isn't. This isn't financial advice. I don't know what silver does tomorrow or next week. Markets don't move in straight lines. Even structural bull markets have violent corrections. Silver could pull back to 65, to 60. Volatility is real. Drawdowns happen. If you can't handle 20% swings, precious metals aren't for you. But I know the pattern. And the pattern says we're in Act 3, a P approaching Act 4, the structural break, the repricing. The moment when old assumptions stop working. Think of silver like insurance, not hoping for monetary collapse, not wishing for a supply crisis, but recognizing risk, understanding that when industrial users panic buy, when 5 years of deficits drain inventories, when China restricts exports, when COMEX inventory falls 73%, physical assets preserve value. The risk is obvious. Act 4 could be an intervention like 1980. Governments could change the rules. Exchanges could force liquidation. The rally could crash by 50% in weeks. Anyone buying at 72 needs to understand that possibility. But the opportunity is also obvious. If Act 4 is repricing instead of a crash, if industrial demand keeps growing, if deficits persist, silver at 72 targeting 100 is 39% upside. Targeting 150 is over double. Targeting 180, the inflation-adjusted 1980 peak, is 249%. I'm not predicting any of those. I'm saying the pattern allows for it. The fundamentals support it. The structure enables it. The rest is probability and timing. So ask yourself, can you see the pattern? Can you see why overnight moves to 72, why industrial panic buying, why COMEX draining, why all of it is happening simultaneously isn't random? It's Act 3, the structural break, the moment before Act 4. Drop a comment. Tell me what you think happens next. Does silver consolidate, pull back, run to 100 before year's end? Or does Act 4 bring intervention and crash like 1980? And if you want to understand what the 1980 crash looked like, the signals before the top, the mistakes investors made, hit subscribe. Because next week I'm breaking down Silver Thursday, March 27th, 1980. 50% drawdown in one session. How it happened. Why did it happen? And what it teaches us about recognizing when Act 3 becomes Act 4. Silver just blasted through $72 overnight. 4 consecutive days of all-time highs. Industrial users are panic buying. COMEX inventories are vanishing. China is restricting exports. 5 consecutive years of structural deficits. The pattern is executing. Act 3 is accelerating toward Act 4. Remember that Roman coin from Act 1? 5% silver, 95% copper. Workers were paid twice daily because morning wages were worthless by afternoon. Remember Nixon closing the gold window in Act 2? Silver $140 to $50 in 9 years. Same pattern, different characters, same ending. We're in Act 3. The pattern doesn't care if you believe it, it just executes. The question isn't if something's happening. The question is whether you understand what